And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts. Presented by RIA Advisors.
And good morning and welcome to the show. Of course, it is Tuesday. It is also April the 1st, which means it's also April Fool's Day. So nothing we tell you today is real. Don't take any of it. Could all be a giant April Fool's joke. We won't tell you till tomorrow. But no, seriously. End of the quarter, finally behind us. Thank goodness. Market down about 6% or so for the first quarter. Terrible first quarter. One of the worst quarters we've seen since 2009. So yeah, it was a bit challenging. But, you got to keep this in a bit of perspective. Yes, the market's down 6% so far this year. That's not great, right? Tough first quarter. It's not great. Can you keep in mind that we just came off two 20% return years in a row, so a little bit of give back should be expected. I know it's been tough, right? I know it's been a tough quarter, but we got to keep some things in perspective relative to markets. Markets have corrections every now and then. Markets have to correct from time to time. So it's important to keep the context of the correction. Why am I telling you this? Because I'm just getting a ton of emails from people just like, the market's crashing, I'm down, X amount this year, and what am I going to do? And look, some of the emails I'm getting are very challenging, right? Because they invested a lot of money kind of right at the peak of the markets in very aggressive stocks, and those are down a lot. So that's a different story. But if you've just been managing your portfolio, just, having a well-diversified, well-balanced portfolio, etc., you're down a little bit this year. But it should be expected given the context of the rallies we had in the last couple of years. So perspective is very important to all of this. And yes, I know we've got a lot of things that are going on right now. There's a lot of concerns. Tariffs, what's happening, economic policy uncertainty we talked about yesterday is, it's rocketing higher here. We just don't know what's going on. So, corrections are part of the process. We have to remember that. And so we don't want to overreact. And again, we do want to take actions, right? And this is why, when markets are trading higher, we tell you to take profits, rebalance risk, rebalance allocations, so that when you get into this environment, A, it doesn't hurt as much, but B, you also have some cash that you can start buying some stuff with, because when it's time to buy, you won't want to, right? And if you are worried about this markets right now, and about where we are, it's like, oh my gosh, I don't want to do anything, or I need, or the converse of that, it's like, oh, I feel I've got to do something. That's generally the time that you need to step back and analyze, okay, what are my emotions telling me versus what do I need to be doing? And again, when it's time to buy equities, you don't want to, because they're beaten up. I mean, if we only bought at highs and everything just kept going up, that would be easy. But buying stocks when they're down and when they're beaten up, that's the hard part of the game, right? That's when you start looking at an NVIDIA or Microsoft or an Apple. These stocks have been under a lot of pressure lately because index funds have been sold pretty heavily in the first quarter. And that's an unusual thing. That's something we haven't seen in the last couple of years, is heavy selling of index funds like SPY, right? The S&P 500 index. And the reason that's important is that feeds into that sell-off in those Mag 7s. Remember, we've talked about before that the Mag 7 stocks are these big beneficiaries of this passive indexing monster, right? There's just kind of blind allocation to those stocks because they make up, about 25-30% of the index just by themselves. The top 10 make up nearly 40, or did make up about 40% of the index. So every time somebody's buying an S&P index, 40 cents are going into those top 10 stocks. And that's why those stocks have had such huge rallies over the last few years, because of all this passive indexing money, this kind of just mindless robot that just dumps money into those stocks. Well, over the last quarter, we saw the reverse of that with people selling their S&P index funds. And that takes 40 cents of the dollar every time it's sold out of those stocks. So it's not surprising that those stocks were the hardest hit during this recent decline. But this is where you've got to come to a decision, right? Have the earnings and fundamentals of those companies changed? Are their valuations cheap or expensive relative to the markets? You know, all those type of questions, because when it comes time to buy those stocks, and I'm not telling you, I'm not saying you should or shouldn't. I'm not making the case for buying the stocks, but my point is that those stocks are getting beaten up, and there is a point that probably they're going to find buyers. And the question is, are you going to be one of them? And can you work through that math of figuring out how to be a buyer when nobody else wants to be? So, all right, with that said, let's talk about what you need to know before the bell this morning. Yesterday marked the end of the quarter. Institutions waited until the very last minute to rebalance portfolios yesterday. Markets started off down about 1.5% in the morning, fairly sharp sell-off early in the morning, retested the lows that we saw back from the initial decline. So we hit that initial bottom, rallied back to the 200-day moving average, failed, came down, retested that low yesterday, and in the minute that we did that, institutions stepped in and started buying, reverted the market all the way back into positive territory. We finished up about 0.5% yesterday. So again, lots of action yesterday in the markets. Again, a lot of buying all day long. Kept the markets kind of intact right now, still oversold. And although we've had this kind of turmoil in the market, we are developing a negative divergence in both relative strength and momentum. So that's a kind of a positive tone underneath the markets, despite this recent kind of sell-off this past week. Now, markets are going to open down a little bit this morning. Again, just, we're this uncertainty over tariffs tomorrow, Liberation Day. What does that mean? Don't know. But the shaded area in the back, this is a Fibonacci retracement. Now, this is just, if you don't understand the Fibonacci sequence, it's called the golden ratio. I'll spend some time on it someday on the show for you, but there's some mathematical equations on pullbacks and extensions that can be measured by the golden ratio or the Fibonacci method. And so what we've done so far is work through a basic retracement. Now, this is from the previous lows, but when we've kind of working through this process, there is kind of a lower level to get to here at 5,400 on the S&P, which would be kind of a 38% retracement of that rally, of that previous rally. So we're working through this process. We're sitting on support right now. We bounced off that support yesterday of that recent low, as well as the kind of these previous tops that we had back in July and August of last year. So there is a bit of support right here that markets are going to try to bounce off of. Now, the big question becomes today, can we hold that level of support? If not, if we break through that, we're going to retest potentially this 5,400 level, do this kind of the second leg of this retracement. But again, tomorrow, depending on what happens with these tariff announcements, and that's the whole thing that the markets are trying to adopt for right now. We're seeing earnings estimates getting slashed right now. We're seeing economic estimates getting slashed right now because of this uncertainty over these tariffs. So if tariffs are more brutal than expected tomorrow, could have a bigger decline in the markets. If they're less brutal than what everybody's expecting, then we could have a really big rally. This is really going to be a tough day to kind of navigate, getting ready for tomorrow. So again, here's the problem that you face right now. If you want to try to short the markets here, you could be terribly wrong. You could also be terribly right. I have no idea, right? And this is the whole problem with the market. The market's trying to figure out this whole tariff situation. So almost any action that you take right now in your portfolio has a very high probability of being the wrong action, both buying or selling. So again, you've got to kind of make your own decision what to do here. But again, once we get through tomorrow, we'll have a much better handle on what to do with portfolios next. But again, this is just something we'll have to work through over the next day or so. But again, kind of building a little bit of positive divergences here. That's encouraging. We saw money flows turn positive yesterday. That's encouraging. So again, don't be overly aggressive today. positioning for tomorrow. We just got to wait, work through that, and then make our decisions from there. That's what you need to know before the bell this morning. We'll come back, pick up with John Penn. A lot of stuff to get into. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
The Real Investment Show YouTube page has all of our videos ready for your easy access. From 3 minutes on markets and money to each day's radio shows like Technically Speaking Tuesday, Financial Fitness Friday, and the latest analysis from Lance Roberts and Michael Leibowitz. Subscribe and bookmark our YouTube channel for The Real Investment Show, or just click on the show links at realinvestmentadvice.com.
RIA Advisors Research is the envy of the industry. Our economic insights are featured on advisorperspectives.com, Fox Business, and MarketWatch. RIA provides advisors with marketing and back office support, objective research, and holistic, cutting-edge financial planning tools to meet your clients' needs. Want to join a winning team and be part of a fiduciary culture where you can do your best work? Then why haven't you contacted us yet? Go to our confidential advisor hub at realinvestmentadvice.com. RIA Advisors. Big enough where it matters, agile enough when it counts.
The Real Investment Show.
Attention Chevron employees and anyone else receiving or considering a company severance package. We know the process can be intimidating. What should you know to maximize your payout? Lump sum or pension annuity, retirement plan rollover or not? What about tax timing your severance? The fiduciary advisors at RIA Advisors can help you make the best decisions for your situation. Call us today at 855-742-7526. That's 855-742-PLAN. Or online at realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. A passive investment portfolio requires active risk management. It's not a choice, it's necessity. Diversification doesn't protect against risk of loss. Let us actively help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
So real quick, I have an article out today talking about the recent failure at the 200-day moving average, and I kind of go through a bit of analysis on what that means historically. And there's one chart in particular I wanted to kind of bring your attention to this morning, which is basically just a chart of the market. There's a couple of things going on here, so just bear with me for a moment, and I'll get through with this. And if you're driving your car, don't try to watch your phone. The article is posted on the website, also on our Substack channel at Lance Roberts. If you're not following me on Substack, you're missing out. We post everything there before. It's a one-stop shop for everything rather than having to hunt around for stuff. Daily market commentary, daily before the bell videos, blogs, newsletters, all right there in one spot. So just follow me at Substack. So the market, and again, is a signal sometimes. The problem that with signals that we have, like failure, breaks of the 200-day moving average, is that they've got to be put into context with what's going on in the rest of the market. And this is the problem with a lot of analysis. They say, oh, it's a break of the 200-day, got to sell everything, right? Got to be careful with that, because that's not the case normally. And what I mean by that is that we have to go back and look at what else is happening in the context of that break of the 200-day moving average. And so what this chart shows you, I'll explain this if you're driving your car, listen to the radio, we appreciate you. But so this chart shows the stock market going back to 1995 versus a red line, which is the 200-day moving average. In the background is S&P 500 earnings. What you will note is that when the market breaks the 200-day moving average, in conjunction with sharp declines in earnings, which typically happens during financial events of some sort, a la failure of Enron, WorldCom.com crash, financial crisis in 2008. When you have those breaks of the 200-day moving average in conjunction with very sharp declines in earnings, estimates are just being ratcheted down rapidly, not tweaked, right? I mean, cut, slash, burned. Those are the moments that you go, I'm out, right? I gotta get out of the market because everything's now in flux. Outside of that, breaks of the 200-day moving average, particularly since 2009, have been very short-lived events that have actually been buying opportunities. And the differences are whether or not, I mean, earnings can, decline a little bit, but there's a difference between declining estimates versus slashes, right? When earnings are going straight down, that's a bad thing. When they're just pulling back a little bit, that's okay. But even in the context of the 2020 economic shutdown, where we had those massive cuts in earnings estimates because of the shutdown of the economy, we also had back then zero interest rates, the Fed stepping in, bailouts, all that type of thing. So since 2009, breaks of the 200-day moving average have typically been buying opportunities versus sell, get out of the markets, and go to cash. I'm not saying that this time is not potentially, a 2008 type event, but we really don't have any of the indicators suggesting that is the case right now. One thing we'll be talking about in Friday's article is credit spreads and a variety of other things, which we're currently not seeing. But, again, one of the best indicators to look at is earnings, because everything that happens in the markets is ultimately, at the end of the day, we talked about this yesterday a bit, no matter what happens in the markets, right? Again, whatever rationalization you want to have, it's tariffs, it's this, it's that, it's the other thing. It all has to do with what does that mean for earnings and forward estimates. There's a very high correlation between the annual rate of change in the markets versus the annual rate of change in earnings. Right now, as of today, the annual rate of change in earnings is higher, not lower. So even with this whole tariff impact that's coming to fruition at the moment, earnings are expected to grow. Now, that growth rate is going to come down a bit, but they're still expected to grow. Even with tariffs, they're expected to grow. And if earnings grow over the next 12 to 24 months, as expected, the market's going to be higher. Because again, what markets will do is start to price for those forward earnings expectations. So if the rate of change for earnings is higher, the market will be higher on an annual rate of basis. So anyway, that whole article is there for you this morning. Either go to our Substack channel at Lance Roberts or on our website, realinvestmentadvice.com. You can download, read the whole article. I posted it up on X this morning to make it easy for you as well. So just pretty much, everywhere you follow us, you'll find the article. But again, the crux of the article is that not every break of the 200-day moving average is the beginning of the end. But let me qualify that by saying it doesn't mean it can't be the beginning of a much bigger correction. But we have to try to look at the data for what the data is telling us right now and then make assessments about, is the recent market turmoil a function of a bigger event evolving that is going to have a negative impact to earnings, which would detail a lower price valuation for the markets because I have to adjust for those lower earnings? Or is this a event that is occurring around an unknown situation with tariffs that can't be priced in effectively right now because they're a moving target, and that once that is done, the markets will be able to adjust and adapt for that? That's the question. And then we'll have to work through that. So anyway, good morning, John. How are you?
Good morning. How are you?
Good.
Happy pre-Liberation Day, or as media calls it, Liberation Day Eve.
It needs to be a national holiday.
I guess so.
We'll be off tomorrow. There will be no show tomorrow morning because we're taking Liberation Day off.
That's right.
We're being liberated from the radio show tomorrow.
Does your wife have a liberation tree up?
No, but don't mention it.
There'll be 20 before you know it.
She'll be like, I didn't think of that. This is genius.
What a great marketing idea.
I'll get home and they'll be like, trees drug out of the closet now. Thanks. That's all I needed.
April Fools.
Yeah, right.
It's hard to believe we're in April already with Q1 behind us. And I think, so what you were talking about here with the 200-day moving average, I've been getting a lot of emails and questions around that too, is, hey, market broke the 200-day, now what? Is this time to get all out? And I think that's what I've been trying to talk or kind of coach people through as of late is, investing doesn't need to be an all or none decision, right? Mm-hmm. I'm trying to help folks realize that, hey, as an investor, set yourself up for what I like to call like a win-win, right? So that you don't necessarily need to be, in a 100% stock portfolio. You don't need to be all in, but have some exposure. So that way, like even if tomorrow, if the news isn't as bad as what the market expects, actually could be a good thing, and the market could do very well. Yep. So if you have some money invested, then you participate and you benefit, right? But at the same time, by design, even here, there's cash that Lance and the team are holding in the portfolio. So that way, if markets have some additional weakness, then that can be used as an opportunity to get things at a better value, right?
No, that's right. And again, like I was saying, it's like when it comes time to buy, that's when you don't want to buy. Your nerves will be telling you not to buy. It'll telling you to run away, right? But that's when you've got to kind of hold your nose and buy. But you got to have some cash to do that with.
You do,
right? And so, that's always kind of the hard part about navigating markets and emotions and all this type of stuff that we talk about on the show all the time, is that you have to do the opposite of what your gut's telling you to do. And like right now, you sent me a note this morning. It's interesting. I'm getting a lot of people asking me, is like, this time just to go buy a bunch of T-bills and chill out again?
Yeah, that's starting to that theme is starting to resurface just a little bit here.
Yeah, I've been getting quite a few emails. And, sure, you can do that, but that did not work well back in 2022. Everybody was like, oh, I can just buy a 5% T-bill. This is great. I'll just hold it till maturity and get 5% of my money. Who cares what happens in the markets? And the markets ripped 20% 2 years in a row. And they're like, how did I miss all that?
Yeah.
Right?
Well, look, it's okay to have some of your portfolio into some short-term treasuries.
Sure.
We do. Right? So
Absolutely.
That way, because, the Fed...
Because in times like this, they provide a nice hedge.
Absolutely. And if the Fed does reduce short-term interest rates a little, towards the end of the year here, it's nice to have some money in the portfolio where your yield will just last a little bit. It'll be more resilient. It'll just last a little bit higher for longer, right? Yep. So there's nothing wrong with having some T-bills in the portfolio, but do you need to go to a 100% T-bill portfolio? I think sometimes when you make that drastic move, then you can look back and go, oh, maybe that wasn't it felt good at the time, but looking back probably wasn't the smartest decision.
Yeah, no. And like there's some people in chat talking right now, you buy puts on the markets, right? Options are fairly cheap. Cheap way to hedge. Sure, absolutely. Just realize that, come tomorrow, if tariffs aren't everything the market is fearing, those puts will expire worthless pretty quickly. And that's okay. That's the cost of insurance, right? That's why we pay for insurance. Hopefully we pay for insurance and we'll never need it. But just in case you do, certainly do that. So yeah, nothing wrong with that. All right, quick break, come back. Don't go away.
The Real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
Oh, Red, I declare, I plumb missed that candy coffee. Whatever am I gonna do?
Don't you worry, little darling. We'll watch it again on our YouTube channel.
Why, Red, I never stuff.
The Real Investment Show YouTube channel has all of our past presentations, from Candid Coffee and Lunch and Learn to special topic discussions, and all of our live show recordings preserved for you. Subscribe now to the Real Investment Show YouTube channel, or look for the link on our website at realinvestmentadvice.com.
Attention Chevron employees and anyone else receiving or considering a company severance package. We know the process can be intimidating. What should you know to maximize your payout? Lump sum or pension annuity, retirement plan rollover or not? What about tax timing your severance? The fiduciary advisors at RIA Advisors can help you make the best decisions for your situation. Call us today at 855-742-7526. That's 855-742-PLAN. Or online at realinvestmentadvice.com.
The Real Investment Show.
Are you a financial advisor sneaking peeks at our stuff? Instead of trying to do it all yourself, why not just join the team at RIA Advisors? Our full-service organization can provide you with the support, unparalleled research, and tools for managing your clients' money and honoring the fiduciary pledge of putting clients' best interest first. Don't take our word for it. Talk to the advisors that work with us. Want to come win with us? Go to our confidential advisor hub at realinvestmentadvice.com. RIA Advisors, big enough where it matters, agile enough when it counts.
And now, another page from the Real Investment Advisors Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
$1 million sounds like a lot of money, and a lot of people don't have $1 million. It's not that much money, considering that most people's net worth isn't $1 million in cash in the bank. That's their house and all their other stuff. That's not liquid. Because if you want to extract the capital from your house, you got to sell it. That's awesome. Where are you going to live?
The Real Investment Show podcast. Same show, your schedule.
I'm going to live in a van down by the river
at realinvestmentadvice.com.
If you're working and looking to retire soon, a Medicare special enrollment period is in your future. Understanding Medicare choices, enrollment deadlines, and costs are essential to your overall standard of living in retirement. The wrong choices can cost you thousands in penalties. Make sense of Medicare's alphabet soup with RIA Advisors' online resources and one-on-one partners to help secure the healthcare insurance choice that is right for your lifestyle and budget and avoid gaps in coverage. Click on the insurance tab at realinvestmentadvice.com today. realinvestmentadvice.com.
The Real Investment Show YouTube channel has all our videos ready for your easy access. Now with the new and improved Before the Bell reports, Technically Speaking Tuesday, Financial Fitness Friday, and the latest analysis from Lance Roberts and Michael Leibowitz, plus each day's radio shows. Subscribe and bookmark our YouTube channel at realinvestmentadvice.com.
You're listening to The Real Investment Show.
I had to chuckle last night. I love my wife. She's the light of my life on many things, and she made me laugh last night because she's got a little hoard in her. She's got a cabinet. Now my wife is and I always tease her because she's short. She's like a midget. She's like 5'4".
Vertically
right?
challenged.
Yeah, she's vertically challenged. And she's convinced, and this is the funniest thing, right? She's convinced that she's 5'5", 5'5.5". She's convinced of this. And so when we went skiing in Denver, and you get to the Denver airport, as you're walking through the Denver airport, they have these pictures of like a grizzly bear and an eagle on the wall. And so like when you walk past the eagle, it has the wingspan of the eagle. And so you can go up to the wall and put your arms out and see how much, how wide the actual wingspan of an eagle is, which is pretty impressive, by the way. And then we get to the bear, which can, a grizzly bear can be up to 9 feet tall. They've got a measuring tape. So all the kids are running up there and they're standing there to see how tall they are relative to the bear, right? And so my wife walks over there and she stands up there and she goes, "See, I'm 5'5", and everybody cracks up because it's 5'4" on the nail, right? And she's like, "Damn it, I'm 5'4". So anyway, in the house, she's got this cabinet, and it's one of the upper cabinets above the microwave, and she's got this little hoard of her little snacks in there, right, that she likes to have, her little snacks and stuff. And so I was in the kitchen. We had dinner, and I was in the kitchen washing up dishes and putting things away. And I hear her rummaging around, and so of course she can't really see what she's rummaging in because she can't see what's in the cabinet. But I just hear all the bags ruffling. Anyway, she comes by and she leaves some. She has a kind of a penchant for jelly beans. And so she likes some jelly beans. And so she walks by the counter, and I'm cleaning up the dishes, and she leaves like 4 jelly beans for me. And I'm like, thank you, honey. That's very sweet. And so I take my 4 jelly beans and I walk over to the couch because we're going to watch an episode of 1923 where it'll be another episode where Dutton doesn't get home.
If you're waiting for that moment at this last episode, sorry, folks.
Yeah, he ain't getting home, and that ain't gonna happen. I love all the TikTok memes going on right now, where it's like 30 years from now, and there's some guy on a walker is like Dutton's almost home.
Maybe they'll have oxygen by then. He's breathing from too.
So anyway, I get to the couch and I sit down. I've got my drink, and I boot up 1923, and I look over. And so next to our couch, there's these little kind of arm tables sort of things next to the couch that you can put your drink on, whatever. And I look over there, and she's got her drink, and there was probably 80 jelly beans on this table. And I'm like, looking at my 4, and I go, thanks for sharing, babe.
Did she just pick out the 4 she didn't want?
I think she just gave me the color. Exactly. I think I just got the colors.
I don't like the licorice ones here.
Yeah.
Yeah, were the black beans?
Yeah, that's it.
Yeah.
Take you out and shoot you.
And so anyway, it was just she made me laugh. It was just very funny. Anyway, I said, I love you, babe. You're awesome. And Dutton still didn't make it home, by the way. He's never getting there. If you're watching 1923, just give it up. It'll be 1945, and he'll finally get home. Anyway, so I wanted to finish up this conversation about the 200-day moving average real quick, because there are some things we can be watching for to determine, A, if we're getting into a much bigger correction, and B, how to act once we start going through that correction. Now, I put all this, again, this is in the article, so again, if you're trying to drive this morning, don't do anything. This is a weekly chart of the S&P 500, which slows the price movement down. But the thing I want you to take away from this is twofold. One, we don't have a weekly sell signal in place yet, which is your kind of indicator of indicators that the market is in a directional trend change from a bullish trend to a bearish trend. The last time we had that signal was back in 2022 when we had the Russian invasion, the Fed's hiking interest rates, etc. The important part to understand is that even in that decline, the market gave you opportunities to sell into. So again, when markets are volatile like they're doing, and again, there's a lot of pressure on markets and people are kind of working off of fear more than analysis, they tend to sell bottoms. And those are typically opportunities where if you're a trader, you can take advantage of them, deep oversold conditions, etc. But even in a more corrective bear market, again, kind of using 2022 as a playbook, and this playbook works out through 2008, worked out through dot-com crash as well. Those environments gave you opportunities to sell into. But that's assuming that we are moving into that bigger bear market cycle. And that is possible. I'm not saying it's not possible, right? That's not my case at all. But we don't have that signal yet. It is approaching, but we don't have it yet. And so we want to be a little bit cautious. And again, this is why weekly data works so much better than daily data when you're trying to navigate short-term variations in the markets. Slow your roll a bit and look at weekly data, because that helps remove a lot of the day-to-day volatility. Kind of gives you a better picture of what's happening in the markets. And markets certainly under pressure here. Absolutely. We're getting oversold even on a weekly basis. And again, you're likely going to have opportunities to sell into markets. In other words, you get to an oversold condition, the market bounces a bit, and there's, we can go a lot further into the detail, but you're going to get opportunities to understand that A, we now have a directional trend change from a bullish trending market to a bearish trending market, and B, how to take advantage of those counter trend rallies to rebalance the risk in your portfolio. So again, this is all in the article, but again, the whole point that I just want to try to get to is to understand, can you just bring this up for me on process? Just to, focus back on your process. Process. That's, out of everything, the best thing you can do is always go back to the basic fundamentals of managing your portfolio. And however you manage your portfolio is fine. We've had conversations here on the show about developing your own investment policy statement, those type of things. But I kind of put a process in this article for you to review, but how to clean up your portfolio, how to compare your portfolio to your model allocation, what actions to take next. They're there for you in the article, but it's also about preparing your portfolio to take advantage of the decline by having cash to invest when markets eventually bottom, and they will. All bear markets end. All corrections end. And so we want to make sure that we're in the right position to take advantage of those endings when they occur. So again, all in the article. Hope that helps.
So can we elaborate on a point here?
Sure.
So using market strength, if there's a rally to kind of sell into, or maybe there's an opportunity to sell into. So let's elaborate a little bit more on that. So if reducing risk in a portfolio, is that getting completely out of stocks? So are you completely out, or
no?
Talk a little bit about that reduction in exposure, what that means, because I get a lot of questions about that, where folks say, okay, are you out completely, or are you just reducing exposure? So could we maybe elaborate a little bit on that?
Yeah.
What that means.
Yeah. No, I mean, one of the biggest, again, I've said this before on the air, my biggest learning experience was 2008.
Yeah.
Because, so we were completely out of the market we got out of the market in 1999. So we missed a little bit of the run up in 1999, but avoided the whole .com crash. But it was a very different environment back then. And because I was running a broker-dealer, not an RIA.
Yeah.
So it was a little different. But 2008 was, in 2001, we had switched over completely to an RIA and was doing, and this was a previous firm, by the way, not this firm. But it's completely switched to an RIA, and we're managing client assets just like we're doing now, managing portfolios, et cetera. And in 2008, about June, July, we got out of all our equities and we're just basically holding, treasury bonds, and which we avoided the crash. The problem came in 2009. I wrote an article about 8 reasons for a bull market, and we started buying equities, and we lost like $100 million in assets because we were like, "Are you crazy? This market's just going down from here." Again, trying to buy when you don't want to buy.
Right.
And so what my lesson that I learned from that is that being completely out of the market is fine. The problem is getting back in, right? And so we modified our process. We never get completely out of the market. So we can get exposure down dramatically. So in a 60-40 allocation, our lowest equity exposure can be 15% equities.
Yeah.
And, maximum exposure can be 70. So we can actually overweight equities. But even when you get down to that level, you think about it mathematically. If the market's down 10%, you have 15% exposure to equities, you're down 1.5, right? That's survivable. But when the market starts to recover, then you start to see those equities. And again, those are defensive equities. They're dividend yielding value stocks, those type of things. They're probably actually performing okay in that environment. But when the market starts to rally again, you see that recovery, and it makes it easier psychologically to put money to work.
To start to nibble.
Yeah.
Yeah.
And again, like we talked about before, the hardest part is buying stuff when you absolutely don't want to buy it. That's the hardest thing to do. All right, quick break. We'll come back. Get ready to wrap up the show. Don't go away.
Investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
Attention Chevron employees and anyone else receiving or considering a company severance package. We know the process can be intimidating. What should you know to maximize your payout? Lump sum or pension annuity, retirement plan rollover or not? What about tax timing your severance? The fiduciary advisors at RIA Advisors can help you make the best decisions for your situation. Call us today at 855-742-7526. That's 855-742-PLAN. Or online at realinvestmentadvice.com.
In 1999, a parafiduciary group of financial advisors were busted by corporate giants for trying to operate in their clients' best interest. These men promptly escaped from a high-cost margin environment to the Houston Energy Corridor. Today, still excoriated by their former employers, they survive as protectors of others' fortunes. If you have a problem about preserving capital, if no one else can help, and you can find them right here, maybe you should hire the RIA team.
The Real Investment Show.
RIA Advisors Research is the envy of the industry. Our economic insights are featured on advisorperspectives.com, Fox Business, and MarketWatch. RIA provides advisors with marketing and back office support, objective research, and holistic, cutting-edge financial planning tools to meet your clients' needs. Want to join a winning team and be part of a fiduciary culture where you can do your best work? Then why haven't you contacted us yet? Go to our confidential advisor hub at realinvestmentadvice.com. RIA Advisors. Big enough where it matters, agile enough when it counts.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors. 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
So there's an interesting Wall Street Journal article, quick shift from the markets. Interesting article in the Wall Street Journal. BlackRock is trying to privatize investing. And it's interesting from a standpoint that private equity, private investments, there's a lot of benefits to that. One of the reasons that we recently launched our private credit fund as well is you get a lot of diversification from the markets, less volatility because you don't see the day-to-day up and downs. You just kind of see the quarterly returns of what the portfolio is doing. It also gives you access to a lot of things that aren't public. And again, one of the things that's occurred in the markets over the last 20 years is that we've gone from 8,000 public companies to 4,000, right? So we're slowly privatizing our public markets anyway, and everything's moving towards private. And so interestingly enough, what Larry Fink is trying to do, Darth Vader for short, he's trying to privatize the public market, for lack of a better term. He says that regular Americans should be able to invest in private assets like private loans, real estate, infrastructure to improve retirement savings. I'm just quoting from the article. Fink proposes expanding access to private markets by improving data transparency, technology, and liquidity, and allowing individuals to invest in private markets and diversify their portfolios. This is a horrible idea for a couple of reasons. First of all, once you make private markets public, you have removed the exclusivity premium of those private investments. You've now made them public. And once you start providing liquidity to these assets, it hurts the private player. What private players need is, for instance, let's say John and I are starting a company, and we're going to start a AI company as an example. And so we go to the private market and we say, hey, we want some capital, and we need, we're going to build this company out, and in 3 years, we're going to, go public or whatever it is. But there's a long window to that. And most private equity, decks, right, or 3 to 5 to 6 to 10 years, depending on what they're investing in. And it can be very long projects, infrastructure, those type of things. So for the average person, right, and this is one of the reasons why, you know, most private investments right now are relegated to, you know, accredited investors, qualified investors, et cetera, is because they have more liquidity. So I can put some money into something and I don't need it. For the average American who has $50,000, $100,000 in, you know, between $50,000 and $100,000 in annual income, and their, you know, total investable net worth is, you know, $50,000 to $100,000 on average, they need that liquidity. If there's a life event that occurs, they need that money back, and they need it now. I need to be able to sell it and do this now. And so this has been a pitch for a while. This actually started under the Obama administration.
Yeah.
He wanted to start he started to want to make, you know, give regular Americans the ability to invest in private markets. And, you know, there's a reason that private markets are private. And again, you can get access to them. I mean, you just have to qualify for them. And the reason that you have to qualify for them is because they are illiquid. And it will cause problems. And so again, it's BlackRock is, you know, absorbing the markets as we know it, right? 10 trillion in assets and growing. And this is another area where they're going, hey, you know what? If I can get this done, look at all the fees we can collect on this, right? This is a money-making thing for BlackRock's not doing you a favor.
Yeah, there's a reason that they want to come to the market with all these opportunities for the quote unquote regular folk, quote unquote, to invest in private equity. Just buy it from us, right? And you know, and even in the article, Fink, he says, you know, he's already putting it out there where he envisions what we call like a traditional 60-40 split, like a 60% equity, 40% bond split. That maybe it moves to like a 30-20, you know, 50% equity, 30% bond, and 20% in alternatives. So all of a sudden now I can already see the questions coming. Well, John, you know, Larry Fink says I should put 20% of my money in alts. Mm-hmm. Is that the hard and fast rule? And the answer is no. It's different for everybody, right? But I appreciate what you're saying, because when I was looking through this too, so the whole draw about, you know, private investments is that, you know, they don't trade publicly, and they're not subject to the whims of the emotions of the publicly traded markets. And there has been a move to try to make, you know, private investments, private credit, alternative investments more readily available for non-accredited investors. Mm-hmm. Just look at interval funds.
Right.
So an interval fund is it's structured very much like an open-ended mutual fund. You know, with an open-ended mutual fund, if I go buy, and I'm going to pick on Vanguard because they're the first one coming to mind. If I go buy a Vanguard Equity Income Fund, you know, I can buy it today. It takes one business day for my money to go in. If I need to sell it, it takes one business day for my money to come out. Well, with an interval fund is investing in things like private loans, private credit, you know, private investments. But interval funds typically offer quarterly redemption periods, so they are more liquid than just kind of your typical straight, you know, private investment or private equity type of investment. And the goal with interval funds was to be less correlated to the markets, you know, less volatile. Go back in Q1 of 2020 and look at how interval funds performed. They sold off just like everything else.
Well, and that is the thing. Ultimately, at the end of the day, is that, and again, you know, you also have to remember that out of all the private equity, right? If you just look straight at private equity, so this is not private credit, it's not private alts, it's not just private equity, which is where basically you're investing in a company and hoping it goes public. The failure rate is around 85%. And, you know, if you take a look at the number of people that, you know, in these private equity investments, I've written articles on this before. I wrote an article, if you go to our website, realinvestmentadvice.com, and type in the search bar at top, say, why am I so lucky? I wrote a whole article about private equity. And the number, you know, when you start talking about people that make a 5X on their private equity investment, like the ones that worked, it's like 2%. About 8% of people get their money back. The rest of everybody else loses money. I mean, so, you know, the failure rates on these things are very, very high. But again, you know, this is, if I'm Fink, right, I'm going, this is a great way. I can get all these companies that want to come public. They come to me. I can put this out in the public market, raise capital for them really quickly, collect fees all along the way. BlackRock doesn't care whether or not you make money or not, right? It's just how fast can I get them funded and how fast can I collect fees on it. And what also occurs out of this, the one benefit of the private market is that private markets tend to filter out the crap, because private investors go, yeah, that's not a good business plan. But when you create an environment where I can just grab flows from people who don't know how to do analysis on what they're investing in, all of a sudden all the crap companies come to market, right? Because I've got to have somebody to put I've got to have somewhere to put this money into. So now you get bad investments coming to markets that shouldn't. And the traditional private market will filter a lot of that stuff out. And again, still a lot of bad stuff gets to market. There's still a lot of losses. But, this is why, you look at the fund that you're doing, make sure you've got good investments and good managers, do the research, those type of things. Again, there's nothing wrong with private equity. It's not something that this is just one of those areas of the markets not everybody should have access to. It's just, you really need to understand what you're getting into.
Yeah, I mean, if incorporated appropriately into an overall diversified portfolio, private investments can work very well. But to your point, it's I don't think it's for the masses. I mean, there's even, talks about trying to allow 401k plan participants to have access to private equity within their 401k plans.
Can we take people that are underfunded for retirement and really screw them over some more?
Well, that's the thing. So I mean, you're already seeing signs like last year. I think 3.6%. I mentioned this last week, but it all ties together. Roughly 3.6% of 401k plan participants started pulling money out of their 401k. Well, you're starting to see, that's starting to increase. So you get something it's got the I don't like it. I don't think private equity should be anywhere in a 401k plan, 403b plan, because a lot of folks out there don't have the balances to support it.
Yeah, no, it's true, and it's a sad day. Anyway, it is April Fool's Day, but Hooters has gone tits up now, so they filed for bankruptcy.
Wow. Wow. I have no comment.
Just goes to show you can serve good breasts, but doesn't mean you're going to make money at it. So anyway, they filed for bankruptcy. The founder is actually doing a private bailout of Hooters to try to keep it alive. So we'll see what happens.
So that should not be a private investment to invest in. Is that what you're saying?
Well, I think
they have good wings.
They have, really. Out of all the places you can get wings, you think they have good wings.
I just wanted your reaction.
One part they need to fix is the food quality.
So I have not been to Hooters in a long, long time. Have not. Just saying.
Hanging out at Twin Peaks now, are you?
No, not doing that either. Nope.
What's the other one?
I promise, Sean, I'm not hanging out at Twin Peaks.
What's the new one? Bombshells. That's the new one.
I've heard.
So you've heard.
That's the word on the street.
Of course, Brent's got a hat over here. It says Bombshells on it.
Turn the camera over there.
Anyway, so that wraps up the show for today. Thank goodness. We'll be back tomorrow. Pick up with Danny Ratliff, talk about the markets, tariff day, obviously tomorrow, Liberation Day. We'll focus through that on Thursday with Michael Liebowitz. We'll dig into all the numbers and what we actually know at that point. Have a great day. We'll see you back here tomorrow.